Yeah, I think in this I-bond issued by the Congo government, the initial response is just okay. I think we got only slightly more than one times oversubscribed. The reason is that doesn't mean that people doesn't like inflation-linked bond, because in the very beginning, the Congo government says that every citizen holding ID, only those citizens holding ID are allowed to buy, and they will be only allocated 10,000, right? So most of the the clients that I talked to, they didn't do it because they don't bother to fill in the form, because after all those paperwork, they only got 10,000 allocation, and plus the 5% coupon, the return will be like $50, right? So that's why initially the response is not that good because of that. If the Congo government allow institutional investors or anyone to subscribe for that, right, the response will be a lot better, because as I said, the coupon is linked to inflation, right? And with the current inflation, right, you at least got 5% per annum in the first year, right? But I think what the Congo government trying to do is to subsidize only retail investor. They don't want to give those benefits to everybody. So that's why, with that restriction, and with the initial comment by the Congo government, the response is only so-so. Investor can buy the I-bond, like this one, to hedge against the inflation. And the other alternative they can look at is to buy the structural note linked to the inflation rate, in Hong Kong or in any other Asian country. Because with the U.S. yield curve right now is very steep, right? You could highly likely to get a participant rate, very attractive participation rate. So you got your principal protected, but at the same time, you got some participation on the upside of the inflation rate. They have to look at the liquidity, because I think I-bond, or because they are the retail bond, right? The liquidity is usually not as good as other government or U.S. government bond, right? For example, in the OTC market, the I-bond is trading at a spread of 1%, right? While in U.S. Treasury, the bid and offer spread is only a few basis points. So liquidity is one part, and the second risk that investors need to consider is the trend of inflation, because bonds like this, right, you've got a higher coupon when inflation rate is continue to go up, right? But if inflation trend down, right, say after 1 or 2 years, right, your coupon will be less and less. But with the I-bond, you got at least 1% as your cushion for interest. Inflation around the world or in Asia, right, will be peaked out in the fourth quarter of this year. This is because we have lots of global uncertainty right now. For example, the recent economic data coming out from the States is pretty weak. The long-farm number last month was weak. Manufacturing number was weak as well. And in Asian country, because most of the Asian countries export to U.S. and Europe, right? They have the same problem. The industrial production number is getting weaker right now. So, and Europe doesn't really have this a lot with the sovereign crisis, that issue problem. So I think with that, looks like the global growth will be slowed down, and with that, inflation will be likely to trending down. For Asian investor, Hong Kong people mentality or Singapore people mentality, if they see the inflation, they will tend to buy property. So that's why property prices in these two countries has gone up a lot. And the other thing investors will tend to do, or we will recommend investors to do, is to buy Asian currency, like Sing dollar or RMB. For example, in Singapore, because of the inflation is also 5 to 6%, their government would tend to use a strong currency to control the inflation. So that's why in Singapore, the Singapore currency year to date has already appreciated about 6% against US dollar, and with the inflation annualized at 5 or 6%, you could probably already cover the inflation rate, right? And in China, the Chinese government policy is to allow RMB to appreciate by 4 to 5% per annum. So with the steady trend of RMB and only going up, only going in one direction, right? It looks like it's quite a good alternative to hedge inflation as well.